How accounting can help generate revenue. Most people think accounting is just about tracking expenses and taxes. But what if I told you that accounting can actually generate revenue? When done strategically, accounting becomes a revenue driver, not just a cost center. Let's break down how. Part 1. Billable expenses and time equals direct revenue. Let's start with the basics. Billable expenses and billable time. If you're in a professional services business like consulting, construction, legal, architecture, marketing, or design, your revenue is often directly tied to your time and cost expenses. This is where accounting becomes an immediate revenue tool. Every hour your team spends on a client project and every out-of-pocket expense related to that engagement has the potential to be billed back to the client, and so it needs to be properly tracked, categorized, and invoiced. That's why your accountant must clearly distinguish between billable versus non-billable time and costs. Think of it like this. Did a team member attend a project meeting? Did you buy materials specifically for a client? Was there travel for a site visit or specialized equipment rented? Every one of those should be captured as a billable line item, tagged with the client or job code, and pushed into your invoicing workflow. And it adds up. A few missed expenses, a few hours of unbilled time across several projects or months, it could cost your business thousands or even tens of thousands of dollars in unrealized revenue. Part 2. Bottom to top profit and loss equals revenue planning tool. Now let's shift gears and talk about one of the most powerful, yet underused tool in accounting, the bottom to top profit and loss analysis. Traditionally, most business owners look at their P&L from the top down, starting with revenue, subtracting expenses, and hoping the number at the bottom is positive. But that's reactive. The bottom to top approach flips this logic and puts you in control. Instead of asking, how much profit did I end up with, you ask, how much profit do I want to create? Let's break it down. 1. Start with your target net profit, say $150,000 for the year. 2. Add your total projected expenses, both fixed costs like rent, payroll, and software, and variable costs like marketing or IT costs. 3. The sum of those two numbers gives you the gross revenue target you need to hit. With that number in hand, you can now reverse engineer your pricing, your sales strategy, and your operations start to focus on building sales upward with intention. This method removes the guesswork and emotional bias from planning. It transforms your P&L from a historical document into a forecasting and goal-setting tool. More importantly, it ensures that your growth targets are profit first. Part 3. Accountability drives performance. So, you've set a revenue goal based on your bottom to top P&L analysis. Great, but a goal by itself is just a number unless you have a team that's aligned, accountable, and performing toward that target. This is where accounting and operational discipline intersect. Through performance tracking, you can't manage what you don't measure, and you can't scale what you don't track. Every team member contributes to your revenue outcomes in some way. And the question becomes, how are you measuring their impact? Start with simple, meaningful KPIs, billable hours, revenue per employee, cost overruns versus job estimates. And no, this isn't about micromanagement. It's about creating a culture of clarity and accountability. Your team should know what success looks like. When expectations are measurable and tied to business results, your people feel more engaged, more focused, and more invested in outcomes. Thank you so much for watching. For more information on how we can support your financial goals, be sure to check the details in the description below or visit our page.